Hi, it's Brian Rose and Colin Powell from Silicon Reel. It's week 8. It's been a crazy adventure. We've met some of the coolest and most innovative people here in London's technology startup scene.
Yeah, it's been an incredible time, blown away all my expectations, and I just can't wait to keep on doing it.
Yeah, you know, it's crazy. It doesn't stop here in the studio. We go out to the Silicon Drinkabout, sponsored by the Three Beards, and about 2 weeks ago, we met the guys at Accenture, and they told us about the FinTech Innovation Lab, and it's this really exciting new program that's happening right now.
Yeah, and it's perfect location. One of the main themes really has been that London has a great opportunity to sort of rule the world in financial technology.
And they're accepting applications from all over the world for any idea you have in fintech. So you can apply up to September 8th. If you're selected, you have like a Dragon's Den style pitch day. And from those people, they select another group and incubate them from January to March of next year. Everything finishes in one big pitch day with VCs there, bank CTOs. It's just an amazing program.
Yeah, the access really is the thing that blows me away. If you're running a fintech startup right now, you know how hard it is to get a hold of these guys. Could take you years. And here they are mentoring you for 3 months. So you really, really should get on the ball here and take advantage of this.
Yeah, I'm so excited to be partnering with these guys. We're going to follow the process for the next 7 months and see what gets produced. And I just think it's the same mentality as Silicon Reel, paying it forward and try to break down some of those innovators' dilemmas that we talk about every week on the show.
Yeah, really, that's the key. The only way the banks are going to improve is if they can get access to the people that are innovating, and this really breaks down that wall.
Until then, we'll keep bringing you great guests, kind of the behind the scenes of what's going on here on the Silicon Roundabout. We'll keep bringing it every week on Silicon Reel, so stay tuned.
Yeah, stay tuned.
All right, crowdfunding. You're the expert. I know you got a question.
Yeah, I just wanted to hear your thoughts on crowdfunding. Where do you think, have you seen it impact? I guess you guys are much bigger, but have you seen it impact sort of the ecosystem of raising funds? And where do you think crowdfunding is in 5 years from now, for example?
So I think crowdfunding is fascinating. We're investors in Seedrs. We're investors in Unbound, which is a crowdfunding platform for novelists. We ourselves actually are crowdsourcing our venture capital funds. So because of the changes to the EIS scheme, the Enterprise Investment Scheme in the UK, instead of getting our money, you putting your money into a pension fund and us getting money from the pension funds, last year we launched direct channel to angels to invest in our funds directly through EIS. So we're actually crowdsourcing investors, and we've I don't know how many, we've got 50 to 100 investors who've personally invested directly with us in the last year. So we're huge believers in cutting out the middlemen and reducing friction in the network if you can. The flip side of that is, I think it's a very young industry. There's lots of pitfalls. If you send a check to a Kickstarter-funded company, and they take $2 million, and they actually needed $5 million, and they never provide you with what you've got. There's no way to get your money back, and I think there's going to be a lot of people get burnt along the way. There's a lot of regulation. There's a lot of problems. I think the heart of people who raise the money is in the right place, and the heart of people who donate the money or give the money is in the right place, and it actually is accelerating the innovation loop because. Instead of an R&D department at Philips trying to figure out what people want, spending years developing it and putting it out to market and finding it fail, you can actually get some level of interest on, through crowdsourcing and get some people showing that they're interested in it. But I think them actually providing cash, I think we're going to have some blow-ups where people, have lost money and never got a product, and there'll be some lawsuits, but it'll mature and it'll take time. So I think it's fascinating. It's all about it's all about using the internet to remove middlemen. We're doing it ourselves. The product design companies are using it to innovate faster. So it's a trend that will continue. Individuals investing in startups rather than funds. There's a reason why the city exists. I would say this, I'm a fund manager. I believe that the fees we charge are justifiable for the work we do. We review thousands of businesses. We invest in a handful. We manage them. For you to do that as an individual, it's fun and it's exciting, but most of what we invest in fails. Most of what you invest in through a crowdsourcing platform will fail. I don't think people are fully prepared for that yet.
Yeah.
And there is a value, there is a reason why the city, is the city. It exists to channel money and manage funds on behalf of companies and investors. So there's a way it can go, but I think there's also some challenges ahead. And the fund management industry is not dead yet.
No.
The city exists because there is some intelligence there, as in they do kind of know what they're doing, and
Yeah.
more so than the average just individual, is what you're saying.
Yeah, I think there's the time it takes to assess company. If you're going to invest in startups taking equity crowdsourcing platforms, you need to take a portfolio approach. I would never just invest in 3 or 4 companies.
Right.
We invest in dozens because we don't even know which ones are going to be successful, but we know you have to invest in dozens. To take the time and evaluate the thousands which are on a crowdsourcing platform, to pick the dozen or 2 dozen that you want to do takes a lot of discipline, a lot of time. You might find you'd rather go off and do something else and pay a fund manager 1 or 2% to do that. Generally, people can pick public stocks all day long. You could crowdsource public stocks all day and pick, but lots of people prefer to give it to a professional fund manager, pay the fees. So there's room for everybody, but I think there is value a professional stock picker provides, and particularly in high-tech startups, there's a lot of management. These companies need follow-on rounds. They need to be right-sized. They need to raise capital or downsize. They need to be exited. It's very difficult to do that with a few shares as an armchair investor. But there's a role for it, definitely. Maybe more funds will crowdsource like we are. Maybe you'll see people actually coming and putting funds, which is actually illegal at the moment because of the Jobs Act in America. All of a sudden, you're going to be able to market funds, which have never been able to be done before. So maybe you'll see people putting money into venture funds through crowdsourcing more than just the individual companies. Once they realize managing 20 or 30 investments individually is quite hard work.
Do you think crowdfunding has, in a way, sort of the entrepreneur now? I think some of the valuations on crowdfunding platforms don't quite add up, but
Yep.
yet they're getting funded.
Yeah.
Is it creating the wrong expectation for some entrepreneurs, and then they come to see you, and you're like, your business isn't worth $1 million?
Yeah, no, I've had this conversation. It's
Right.
angels. There's a big risk in getting the pricing wrong and getting. Of course, when you're an entrepreneur, you want to retain as much as possible, and you want the highest price because it makes you feel good. But if you take money from an angel or crowdsourcing platform, or for us at the wrong price, and you don't get to the next milestone and haven't created value, and you need to raise more money, going back to my Gutenberg story, then there's going to be pain, and the investors are going to be sorry, you're going to be sorry. So I would say this, wouldn't I? But pricing your company right, getting the right level of dilution is right, making sure you raise enough to get to where you want to go is right. And there is going to be a lot of pain felt out there. We have seen some great companies that we would like to invest in, but because the previous round is valued so high, nobody wants to take the pain. The company can't actually raise money.
Right.
In the Valley, it's much more mature now. You have convertible. Basically, most people are doing convertibles, which takes that risk out. So they'll put the money in at a discount to the next round, and we think that's great. It makes a lot of. If you like the company, don't want to get into a pricing argument, put a convertible in, make a 50% discount on it or whatever, and when the VCs or whoever funds it in a year's time, you've made a decent return.
Is that like a convertible bond where you put in the money and then you have an option to buy it at a certain valuation?
You put the money in, and instead of agreeing what the price is, you set the price at a discount to the next round. So the next time it raises money, you get an automatic uplift.
Okay,
You get
at 50% or whatever.
Yeah,
Okay.
so 10, 20, 30, 40, 50%, depending on how long it is. And that's most people in the Valley are now doing convertibles to take that whole pricing in, because what's an idea worth? What is an idea worth? It's
Sure.
It's actually, for me, the reason why venture capital works is we take minority stakes. Our average investment is $10 million, and our average equity is 20 to 25%. We don't want 75% of the company. We want the people who own the 75% to be so motivated that they're going to make our 25% worth a lot of money. So, and that's why venture capital works. But if we had 5%, we're kind of misaligned, because the founder is going to get 95% of the upside, and it doesn't matter if it's 100 million or 200 million, it doesn't make that much difference to us. So we need enough of the company to get some value out of the upside.
But knowing that you have to add value from day one, and that just generally being smart doesn't have value, was a really, really useful bit of guidance.
Okay. Last part of this question, and I'm going to ask you this same question next. To the 20-year-old that's listening to this right now, and they're thinking,